If you or your spouse can qualify for this real estate professional designation, now you can deduct this passive loss from your real estate investments against your active income and not have those same restrictions as before. The key here is to be able to actually qualify for this real estate professional designation, because this is not something that you can just do passively. This is something where you have to show material participation as a real estate professional, working in the real estate space for at least 750 hours a year. This is not something you want to take lightly, because if you do this wrong, again, you'll be penalized, you'll pay interest and fees, and you don't want to get in trouble with the IRS. This is why you want to have a good accountant on your side that can help you with this, because let's just say your spouse does not work, but she helps manages your rental properties. Well, now you might be able to qualify for this, but again, there are a lot of nuances here. Get yourself a good accountant, because a good accountant can help you qualify for things like this, or show you how to qualify for this. That way, if you have a paper loss, you're making money, you have no taxable income, you can take that loss and then deduct it against your business income, your job income, regardless of what your income is, because now you can bypass those exclusions by qualifying as a real estate professional. And then we have number 4, section 1031. This is another favorite by real estate investors, because you don't see this in other asset classes like the stock market. But what this says is you can do a like-kind exchange and not pay taxes on your profits. Let me show you what that means. So if you go and you buy this apartment complex for $1 million, it doesn't have to be an apartment complex. It can also be a single family home that you buy as a rental. The key is that you're buying this property, whether it's a $100,000 single family home or a $100 million commercial building, it does not matter. You're buying this not to live in yourself, you're buying this as an investment property. So if we buy this $1 million apartment complex and it's making you that $100,000 a year in income, you're taking this depreciation against your income because you're telling the IRS, hey, my property is a year older, I deserve a tax break. But then you go and find out that your property is now worth $5 million. You've been taking this write-off, this depreciation write-off, because your property is a year older each and every year, but now you find out that your property is worth $5 million. One of the things that you can do is you can go out and do this 1031 exchange, meaning you can sell this property, pocket this $5 million, use this $5 million to buy a bigger apartment complex that is producing larger cash flows. And if you use all $5 million to buy this property, well, then you can pay $0 in taxes on those profits. Now, you know that normally if you buy a stock for $1 million and sell it for $5 million, that you're going to have $4 million taxable income. You can make the number smaller. If you buy a stock for $1 and sell it for $5, you'd have $4 of taxable income. If you buy a piece of real estate for $100,000, sell it for $500,000, you'd have $400,000 of taxable income. But here, with the 1031 exchange, if this is an investment property and you use your profits to buy another investment property, well, now you can pay $0 in taxes today and do it again and again and again until you die and never have to pay a penny in these capital gains taxes. This is what many real estate investors do. You can now buy this property for $5 million, hold on to it for a number of years, maybe it's worth $20 million one day, and then you flip it into a bigger property, a $20 million property, take all the cash, buy a $20 million property, and now pay $0 in taxes again. And then you can do the same thing. Hold that $20 million property, generate the cash flow, make your money from the cash flow, and then flip it into a $50 million property again and again and again. If you do that and you don't sell and keep the money in your pocket, well, now you don't have to pay any taxes, and some people will do this until they die. That way then your property will then pass down to your kids, and they don't have to start at the $1 million base, because it's called stepped up basis. In the IRS's eyes, your children are buying the house at the price that they get it at. So if the property is worth $50 million, you die and then you give it to your kids are essentially buying this property with a basis of $50 million. So if they sold it for $50 million, they have a $0 taxable income. This is what wealthy people are doing. They're taking advantage of this 1031 exchange to compound their wealth tax-free, because now you can grow your properties, assuming that you don't sell it to keep the money in your pocket. If you sell the properties and buy bigger properties, you can use the cash flow, potentially do a cash out refinance out of the properties tax-free, but then also flip into bigger properties as long as you own these buildings for at least 1 year and use this money to buy a bigger property. That's how the like-kind exchange works. Just make sure, again, you're using a good advisor because there's a lot of nuances here to this 1031 exchange, and if you do it wrong, well then you're gonna have to pay all the penalties and fees and taxes that you were trying to avoid in the first place. The fifth tax write-off that you need to understand are ordinary and necessary expenses. The IRS says that every business has the ability to take a tax write-off for ordinary and necessary expenses to run their business. Now, what you have to understand is, what are ordinary and necessary expenses? Maybe your business needs a laptop. Maybe your business needs a cell phone. And if you can use this in your business and potentially use it in your personal life, well, now you get that benefit. But you cannot take a 100% deduction on your laptop and phone if you're also using it in your personal life. It has to be a business expense. But let's think a little bit broader here. Over the next few weeks, I have to travel to Manhattan and Miami and Atlanta to do some podcasts, to do some interviews, and to speak on stage. So my business partner and I are going to have to fly to these cities. We're going to have to stay in hotels. We're going to have to eat meals and rent cars and do all of these things. All of these are an ordinary and necessary expense to run my business because I have to go there to go on a podcast. I have to go there to speak. I have to go there to meet people and have meetings. And along the way, we have to eat. Now, I should also clarify that my business partner is my wife. And so my wife and I now get to travel to these places for business, and we get to write off the cost of the flights, the hotels, a piece of the meals, and other things there because they are ordinary and necessary expenses to run the business. Again, this is where you want to have a good accountant on your side that can help you come up with what is an ordinary and necessary expense. Everybody can start a business. You don't need to make millions of dollars a year to have a business, but you can start a side hustle off of your phone, off of your computer. And now you might be able to qualify for certain ordinary and necessary expenses. If you have a food blog and you're talking about how to build recipes, how to create certain meals, and you need to renovate your kitchen, is that $40,000 kitchen remodel an ordinary and necessary expense to run your food blog? Maybe. It depends how you justify it to the IRS, and this is where a good accountant can help you determine what is an ordinary and necessary expense and what is not, because again, the tax code is a rule book. You want somebody that understands the rule book, that way you can use it to your advantage, because if you don't, well then you don't get to benefit from any of the advantages that you could. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you gotta do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.